The numbers today were significant, and I agree with you that the revisions downward in the previous 2 months were perhaps the bigger story. Look, we've now seen with these revisions a real clear signal that employment markets are slowing down in a significant way. I would say off of pretty solid levels before. So the question that is in my mind is really, to what extent is this a one-time move down that will persist over time? Or is this something that we will see where the labor markets will return back to their basically waiting to see where things are? But going into this week, I thought that the risks to inflation were much greater than the risk to employment. Our inflation rate, our core PCE, was at 2.8. It was not moving toward 2%. All the context we were hearing were saying that price pressures were going up, and labor markets were quite steady. Unemployment was at 4.1%. Wages were solid, and employment growth was solid. The numbers today and the revisions in an important way suggest that maybe the economy and the labor market is weakening more broadly than certainly what we're seeing in the 6th District. But that does also suggest that the risks to the employment side of the mandate are maybe coming more into balance with those in inflation, and that's something that I'll really have to look at as I think about the appropriate path for policy.